Put debit spreads. What is a put debit spread? This is when you buy a put option while simultaneously selling another put option with a lower strike price on the same underlying asset and expiration date. Why would you use a put debit spread? Well, you would use this if you have a moderate bearish outlook and you would like a lower cost compared to buying a put outright. Where would you see your profit? Well, you would see this in the difference between the strike prices minus the net premium paid. And your loss would be limited to the net premium paid. That means you can never lose more than you originally spent. Why is it called a debit spread? You can also see that it's called a vertical in platforms such as Thinkorswim. The term debit is used because typically executing this strategy results in a net cost or debit. That means you're paying to get into the trade. It also means that you're often paying more for the long put than what you'll receive for selling the short put. This is why the trade overall creates a debit. So let's talk about some positives and negatives. Well, on the positive side, this strategy is going to be more conservative than just buying puts. Setting up a proper debit spread enables you to pay less than a put alone to be directionally long. This is why it's a little bit more conservative, and it's also a little bit more conservative because it'll trade a little bit better throughout volatility. It's going to hurt a lot less than directional options in case the stock trades sideways instead of exploding higher, which is also why it's a little bit more conservative than just buying puts. You can still make money on this strategy if the underlying trades slowly higher without an explosive move. What are some negatives? Well, it's more conservative, but you also cap your gains and have limited potential. You pay less because you're selling a higher price strike when you buy the put, but that higher price strike is where your profits are capped. It does hurt less if you're wrong, but you should still go into it risking the debit paid, just like with long puts. If your strike goes out of the money, then you'll start losing money. Let's look at some examples. When you're setting up a put debit spread, it's important to have a reason for getting into the trade. That's generally going to start with technical and fundamental analysis. Here's an example of a chart, and this is Zoom on a weekly time frame. You can see that this chart is in a downward trend. At one point, it was trading all the way up here at about $120 a share, actually significantly higher than what you can see on this chart. And you can see that it's been in a long-term downtrend for quite some time. At this point, you're right here underneath these key areas of resistance. You have a squeeze and you have volume outflow. So there's multiple different technical reasons why you look at this chart and say, hey, you know what? I would like to be short Zoom. And I have a few reasons. We have some fundamental reasons. Zoom had an explosion throughout the pandemic and they've been rolling ever since. They kind of hit that peak excitement and growth as kind of a pandemic stock. We also have a lot of technical reasons with the long-term weekly downtrend. You have consolidation set up. You also have this previous low at $60, which is right near a downside target if you threw some Fibonacci extensions on here. And then you also have the squeeze, which is going to be the consolidation breakout signal. So whenever you're looking at a setup, you're going to want to identify a price target, whether you're using a put debit spread or any other option strategy, and you're going to want to do that using technical analysis in your options chain. So, as mentioned, you're going to want to identify your price target using a combination of technical, fundamental analysis, and options expertise. So, with this example, I'm targeting about $60 on Zoom. Here is how I would set it up. Now, if you look at my trading platform, this is going to be Thinkorswim. This is a trading platform I use. I personally think it's the best options trading platform, which is why I use it. I also love their charting. You can see that they actually are going to call this a vertical in Thinkorswim, but it is actually going to be a debit spread. So on this screenshot, you can see that I am buying the October 20th 70 put, and I am selling the October 20th 60 put. That is going to be for a debit of $2.91. That means that's how much I'm going to pay to get into the trade. And that's for one contract. The max loss is going to be exactly what I paid, $291, which is $291. and the max profit is going to be $700. So when you're risking about 300 to make about 700, it's a little bit better than risking one to make two. And buying one put and selling another put is going to create a spread. And if we go back to this slide right here, you can see that I couldn't show both of the strikes here, but you can see that the first put is going to be a cost of $3.20, and then the second one, the $60 strike, is going to be for a credit. So altogether, it's going to bring down the cost of the long put by about 30 cents or so. So, brings down your cost slightly there, and you can see your risk to reward. And when you're looking at your potential profit, here's another screenshot of my options chain. I went ahead and put the theoretical price on here. What that does is it allows you to see what the option would be worth if the stock actually moved the amount that you're speculating. So I changed this to saying, okay, what if the stock actually does move by about $9, trading lower about $9 over the span of about 2.5 weeks or so? How much money would I make? Well, the original debit spread had a cost basis of $2.91. If Zoom did fall $9, then the target spread would be about $8.39. That's because the price of this $70 put would go up to about $10.15. This is actually demonstrating that the put that I sold would go up in value as well. And the reason for that is because if this occurred around October 9th, it wouldn't be close enough to expiration for it to actually be decaying enough in value. And it would also be close to being at the money. So in this example, this one is actually going up as well. Ideally, with a debit spread, you're going to have the strike that you sold going down in value, but you would still make plenty of money on this strategy as long as, it fell the amount that you were speculating for it to fall, because this long put would go up in value quite a bit. So your theoretical profit target would be about $5.48 per contract, because, if it's worth $8.39 and you subtract what you paid, that would be what you're getting out of it. So I like these kind of spreads because they do have a bit of protection against volatility. That's because you're both buying and selling options in the strategy. The effects of the volatility changes are somewhat offset. So that's just primarily because, if you're trading sideways, that short strike is generally going to be decaying as you get closer to expiration. As you saw in the example, if you're still, a week and a half away from expiration and you're right near that short strike, it's not going to decay like you want it to. So it's funny because in these kind of strategies, it's actually more beneficial if you see price action trading up and down through, right around those, right in between your strikes, because it allows that short strike to decay as well. So it doesn't need to go, directly to the target early. It's actually more beneficial if it's kind of chopping and trading around. So that's why I like the strategy, because most of the time, the market's not going to be making these huge directional moves. And most of the time, you're going to be benefited more by trading something that, allows you to capitalize when the market's just kind of meandering in a direction. So, in conclusion, why would you use a put debit spread? You would use this if you had a bearish outlook with defined risk. A put debit spread is typically used when a trader has a moderately bearish outlook on the underlying asset. This strategy allows the trader to benefit from a decline in the asset's price, but with limited risk compared to just buying a put outright. It comes with a lower cost. The premium received from selling the lower strike put reduces the cost of buying the higher strike put. This means that the trader's initial investment, the debit, is less than it would be if they purchased only a single put option. There's limited downside risk, unlike selling a put outright, where potential loss can be substantial if the underlying rises significantly. The potential loss in a put debit spread is capped to the net debit paid. So those are the reasons why I like put debit spreads, especially, they're a great strategy to use in a downward trending market. Anytime you want to be short, you want to be a little bit more conservative, spend less money than buying long puts. Other than that, I hope you enjoyed this video. During the next video, we are going to be talking about my absolute favorite strategy, which is going to be butterflies. I look forward to seeing you there.